With the Federal Reserve continuing to raise interest rates, 2023 might just be the best year to save your cash in a high-yield savings account or CDs. We haven't seen interest rates this high since 2007, so not many people are used to the idea of saving cash in a savings account. But in this video, I'm gonna focus on the CD saving strategy or the CD ladder, and the CD stands for Certificate of Deposit. Not this CD. It's embarrassing to say that before I got into the financial industry, I always thought CD saving was just putting money in a disc. Anyway, a CD ladder is a very simple saving strategy for anyone who has excess cash they want to hold for the short and long term. But is a CD saving strategy right for everyone? Before you get all excited about the high interest rates, you need to first understand if a CD is right for you. Second, you need to know the timeline of the CD ladder to find out what types of CDs are right for your cash savings. And third, you need to understand the rules of holding a CD so that you don't end up paying a penalty fee that could hurt your savings in the short term. So the first thing you need to find out is how much cash you have total in your savings accounts. The second thing you need to do is assign a purpose or reason for every dollar you have in cash. I'm not talking about your investments or retirement accounts. I'm only talking about the cash you have in your savings accounts. You don't need to do what I do with my savings, but it's worked out pretty well for me for many years. For short-term savings, you need to see how much of that cash savings is in emergency savings. I always recommend that you have your emergency cash savings in a completely separate savings account. And I have my savings with Ally Bank, and I have several accounts with a purpose assigned to each one of them. And I have a savings account strictly for emergency use only. And that means I can only use it for something that's completely unexpected and necessary. If I get a blown tire or pay a visit to the ER, those are unexpected and necessary, right? The next savings account I have is my travel fund, which is strictly used for all the travel I go on every single year. My third savings account is my discretionary spending account, which I use for birthdays, anniversaries, parties, or anything that's discretionary, where I would spend more than $200 or $300 in one single event. My fourth savings account is my annual expenses account, which is used for anything necessary and expected. That requires more than $200 in a single transaction or in one expense. For example, I pay my car insurance twice a year or every 6 months because that's how I get a major discount from my insurance company for doing that. So if I pay $1,500 every 6 months for my car insurance, that's $3,000 a year, right? Instead of budgeting for $1,500 every 6 months, I just save $116 every 2 weeks into this annual expenses account. So I'm always gonna have at least $3,000 in this account to pay my car insurance every 6 months. And when I'm ready to retire, I'm gonna have at least 2 years of expenses in my emergency savings in case of a bear market when I'm living on my investments. Am I gonna put $200,000 into a single CD? Probably not. Another reason to put my cash into a CD would be if I'm saving to buy a primary residence or an investment property. If I know that it's gonna take me less than 3 years to buy a property, I'd rather put cash into a CD instead of investing in an index fund. If I'm not looking to make a big purchase, like buying a property for more than 3 years, then I'd rather put some of that money in an index fund. Just remember that CDs can provide some guaranteed returns over time in a level of security, but they're not meant to be used to build your wealth over time. You're using these CDs to protect some of your cash that you're not gonna use for a while against inflation. And don't forget to download my financial independence resources, including the spreadsheet I just showed you, for absolutely free by visiting firesightchat.com/contact. You should also check out my Fireside Chat shop to check out the books and equipment I use at firesightchat.com/shopping. But when should you not use a CD? Reason number one is if you're in the process of building an emergency fund. You need to make sure that you have access to that emergency fund 24/7 whenever you need it for an emergency. My emergency fund has 6 months of expenses saved. And when I retire early, I'm gonna have more than 2 years of expenses saved. My plan is to keep 6 months of expenses saved in a high yield savings account that I can access anytime and keep 18 months of expenses in a CD ladder, which I'll talk about in a little bit. And reason number 2 is if you're still repaying your debt with the exception of your mortgage. If you carry a balance on your credit card or you're in the process of paying off your personal loans, student loans, or car loans, you need to take care of those first with the excess cash you have before you put money into a CD. And reason number 3 is if you need to spend your cash in the short term. The 4 savings accounts I talked about earlier, like my annual expenses, discretionary, travel, and emergency funds, are the cash that I need to keep in the high yield savings accounts because I need to have access to that liquidity in the short term. Because if I put all of that cash in a CD or a CD ladder and I end up needing that cash in the short term, I could end up paying a penalty for the early withdrawal, and the early withdrawal penalty varies by bank and the term of a CD at the same bank. If you have money in a CD with a longer term, like a 3-year CD or a 5-year CD, you might have to deal with a higher penalty than a short-term CD, like a 3-month CD or a 6-month CD. When you open a CD, you have an agreement with the CD that you will not make any early withdrawals until the funds reach the maturity date. Let me give you an example here. And let's just say that I put $10,000 in an 18-month CD yielding 5% in APY. If I make the decision to withdraw 6 months early and the bank charges me 60 days of interest for the early withdrawal penalty, then that's roughly $80 in early withdrawal penalty, and I lose $260 in interest for the remaining 6 months. For the 12 months I have saved so far, I will have a final balance of $10,420 out of the 18-month term instead of $10,760 if I just kept the money for the whole 18 months. So most banks have early withdrawal penalties, but Ally Bank actually has a no penalty CD with 4.35% APY in 11 months. Now, I'm not sponsored by Ally Bank, but I've been banking with them for over 6 years now because it is my reliable bank, and there's no minimum deposit required to open a CD. It is FDIC insured, and there are no monthly maintenance fees. By the way, if you're interested in joining my private individual, couple, or group sessions, or my private Facebook group, you can sign up for my private membership group on my main YouTube page or by visiting firesightchat.com/coaching to discuss your financial independence journey. When I retire early at the age of 45, the emergency savings, or what I call the bear market savings, will go into a CD ladder. Let's just say that for the sake of this discussion, I'm gonna put $250,000 into a CD ladder to keep it under the FDIC insurance limit. And I just need to make sure that I don't need the cash for at least a year so I don't deal with the early withdrawal penalty. So for example, let's say in this CD ladder, I have a 1-year CD at 3.5%, a 2-year CD at 4%, a 3-year CD at 4.5%, a 4-year CD at 4.75%, and a 5-year CD at 5% with $50,000 each. And keep in mind that these rates might be different depending on when you're watching this video. And there's a good chance that the Fed will cut interest rates 6 to 9 months from now. But anyway, when the first CD matures after a year, I can either cash out or continue to build my ladder by reinvesting the funds into a new 5-year CD with a higher yield. When the 2-year CD matures a year from now, I can put that money into a new 5-year CD. In a perfect world, I just keep the same process going while I continue earning interest from each CD. But I don't have to maintain the same amount for every CD. Let me erase this real quick. And I might not be comfortable keeping $50,000 in a 5-year CD. So I could adjust that to something like $30,000, $20,000, or something lower to test things out. But if I'm not looking to touch some of the cash in a while, I could save more in longer term CDs with higher rates instead. And I could put $100,000 in a 5-year CD if I want to maintain that 5% APY for the next 5 years, because I'm thinking the Fed will most likely cut interest rates. It's completely up to you. Just keep in mind about the early withdrawal penalty I talked about earlier in this video. If you take a look at Ally Bank, you could create your own CD ladder by doing the 3-month term, 6 months, 9 months, 12 months, 18 months, and 3 years. And they also have 2 and 4-year terms, or what's called raise your rate CD. And basically, if their rates go up, then you can raise yours too. And you could split your cash between these terms so that your entire cash isn't tied up with one CD. The downside of having too many CDs at the same time or using a CD ladder strategy is that you'll have to keep track of multiple maturity dates between these CDs. You also have a short time window of about a week or two to withdraw the money from a CD penalty free. So you need to write them down on a spreadsheet or something to keep track of the dates. Your bank will automatically renew CDs for the same term that you originally chose if you don't do anything with them. The other downside is that you could lose purchasing power if you keep some of these CDs for the long term. Again, the purpose of keeping your cash is to buy an asset like real estate that can appreciate in the long term, unless you're saving it for emergency expenses for your early retirement. And I also don't have to open all of my CDs at the same bank to build my CD ladder. The interest rates will likely change every year that goes by. Maybe I want to keep the first 2 CDs, let's say with Bank A, a 3-year CD with Bank B, and the last 2 CDs with Bank C. This is a smart move if you have more than $250,000 in cash to stay under the FDIC insurance limit. Remember that your FDIC insurance limit is $250,000 per depositor in a bank, no matter how many accounts you have. And if you have $300,000 in total cash with Ally Bank, you're $50,000 over the FDIC insurance limit. During recessionary times, it is safer to stay under the insurance limit just in case your bank fails. And you also want to keep your overall net worth allocation in mind. If your net worth is $500,000 and you're keeping $250,000 in CDs, that's 50% of your net worth in cash. That may be a negative indicator that you have too much cash in your net worth. And I personally like to keep anywhere between 10 and 15% of my net worth in cash, but that number suits my financial situation. If you're in debt, not counting your mortgage, then having more cash than your investments make more sense. If you're in the process of building your emergency fund, then it makes sense to have 40 or 50% of your net worth in cash because you haven't really started investing for retirement or early retirement yet, right? But if your net worth is let's say $3 million, then $250,000 is only 8% of your net worth. My point is that you should calculate your net worth and use the percentage instead of the total amount when it comes to cash allocation. And you need to be comfortable with the decision to save some of your cash in a long-term CD. And you also need to know why you're saving some of that cash in a CD ladder. Are you moving that cash in a CD ladder strictly for capital preservation? Or are you saving some of that money for future real estate purchases? Or are you trying to earn more interest on the excess emergency fund so that you don't lose too much to inflation? What you also don't want to do is put too much in a CD ladder and not invest enough for your retirement or other intermediate investments. When you calculate your net worth, make sure to find a balance between how much cash you want to keep in a CD ladder, how much you have invested in retirement, and how much you have saved so that you can spend it in the short term. The last thing I want you to do is to miss out on long-term investments because you're trying to chase a 5% APY with a CD. And if you want to know more about how I created an investment timeline for my early retirement and how I diversified my cash savings, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.